us for our webinar on land banking with your IRA or 401k. I'm very excited to have Kevin Perkins of CalChoice Investments on the call with us today. A little housekeeping. I'll get started here. I'll speak for about 15 minutes or so. I'll turn it over to Kevin, let him talk about the land banking opportunities there are, and we'll leave some time for Q&A at the end. If anybody has any questions during the presentation, please feel free to go in the questions section of the webinar and ask a question, or in the chat box. You can go ahead and ask a question there in the chat section of the panel there that should be on the right. Everybody's muted except for Kevin and myself, so please feel free to ask any questions in that section. So let's get going here. A little disclaimer before I start. AccuPlan, we do not provide investment advice or endorse any investments. We're third-party administrators. All information here is for educational purposes only. Please consult with all of your legal counsel and financial experts before entering into any type of investment. Now that the legal part's done, I'll kind of get started. I'll talk a little bit about myself. Again, my name is Brian Davis. For those of you who don't know me, I'm the Director of Business Development for AccuPlan in San Diego. I've been in the self-directed IRA space for just about 5 years now. I've been with AccuPlan for the last 2. I was with another custodian before that. My background, I come from a family of rice farmers up in Northern California. I went to college at UC Santa Barbara, and shortly after I graduated Santa Barbara, I moved down to San Diego at the very beginning of 2002 and got into the mortgage industry at that time. And it was a good time to get into the mortgage industry in 2002, and things were going, very well there until about 2007. And for most of you that remember, in 2007, the real estate market kind of hit a little bit differently. And I was in a build division, and people weren't building properties anymore. And people also weren't doing subprime loans, which is what I was doing. So for a year or two there, I was doing life insurance and annuities, so I was starting to deal with retirement accounts. And in 2009, I kind of stumbled upon an opportunity doing self-directed IRAs. So that's what I've been doing ever since. And now that there we go, got my slides back. I've been with AccuPlan in the last 2 years here. And AccuPlan, we're one of the premier providers of self-directed IRAs and 401k administrative products. We have our own trust company called American Estate and Trust, which allows us to be an IRA custodian, and we administer those products to allow people to invest in everything allowable under IRS guidelines. A lot of you might not know all about the self-directed IRA, but hopefully through this you'll know a little bit more. IRAs were kind of started in 1974 from a congressional act called ERISA. ERISA outlined the current IRA structure that we see today. There's an IRA custodian involved to help direct your investments. That custodian has generally been the brokerage houses and insurance companies that specialize in securitized products. And by securitized products, I mean publicly traded products like stocks, bonds, mutual funds, ETFs, those types of publicly traded investments. And insurance companies, they do annuities. But trust companies, they also are allowed to be custodians. And what we allow is for everything allowable under the IRS guidelines that those custodians, the brokerage house and insurance companies, don't allow. So we'll go into that a little bit more here in a second. Just a few years ago, there was just about $5 trillion in just IRA assets. That's not including qualified plans like 401ks and IRAs, just in IRAs. And we're seeing the majority of that's with those traditional custodians, those brokerage houses and insurance companies. At the time, there's a little bit less than 2% in the quote-unquote alternative asset marketplace, which is what we deal with today. Now that number's grown closer to 4%, the last numbers I heard. And the reason for that is the rise of the information age. People are being able to go online, see that they have other options besides the stock market, and can learn that there's custodians like us so they can invest in those assets. Another helpful hand was when Mitt Romney was running for president a couple years ago. It came out he had a self-directed IRA worth somewhere around $100 million. So with the rise of the information age and people like Mitt Romney in this space, it's a growing industry. It's a growing asset class. And the asset classes that we're mostly seeing are these here. Real estate, we're going to talk a bit more today with Kevin. Notes, private companies, and precious metals. So that's not everything out there. You can see from this list here, there's just about anything. You can invest in tax liens, limited liability companies, oil and gas, water rights, promissory notes. The list can go on and on and on. The IRS never made a list of quote-unquote acceptable investments. They only listed what wasn't acceptable. And they really only listed two things as unacceptable IRA investments, and that is life insurance contracts and what they deem as a collectible here. And this slide shows some examples of what the IRS deems as a collectible. A work of art, rug or stamp, alcoholic beverage, anything illegal. So you see it's very limited to what the IRS said you can't invest in. You'll also probably hear, if you've done some research on self-directed IRAs, that S-Corps. IRAs can't invest in S-Corps. That's an S-Corp rule that they don't allow IRAs to be members. But I do see people loan money to S-Corps all the time. So those are some of the unacceptable investments in the IRA, which is different from the next part here I want to talk about, which is prohibited transactions. The IRS has stepped in and said there are certain types of transactions that your IRA can get involved in that we were saying are prohibited. And the easiest way to think about this is there's no self-dealing in the IRA. So a prohibited transaction is when your IRA gets involved with a quote-unquote disqualified person. And this can be looked up in the Internal Revenue Code 4975 if you want to do some light tax reading. But this outlines for retirement plans who the IRA basically can and can't invest in. And like I said, think about it as there's no self-dealing. And besides yourself, you want to think about a straight line up and down of people that are related to you. So besides your spouse, your parents, your grandparents, your kids and their spouses, grandkids and their spouses, and any company in which one of those people is generally the majority owner of. Again, there's more detail of it in the tax code, but these are the basics here. We'll try to go through some examples here. If your IRA gets involved with one of these disqualified persons and the IRS deems it a prohibited transaction, they can go back and disqualify your whole IRA that you were invested in. So let's say, for example, you bought an investment property and you paid your college-age kid to do the painting of it. The IRS would consider that a no-no, and they can go back and disqualify that whole IRA, which could have some huge tax consequences for you. So let's kind of go over this a little bit in more detail to get a little bit better understanding of prohibited transactions and disqualified persons. I'm sure most people remember the NBC game show Deal or No Deal from a few years back. So could your IRA lend you $10,000? Deal or no deal? That one's pretty simple. That's self-dealing. That's no deal. You can't lend yourself money from an IRA. Rules are a little bit different from a 401k, and we'll get into that in a little bit. Now, what about your brother? Can your IRA lend your brother $10,000? Deal or no deal? That one could be a deal if you wanted to. The brother doesn't fall in that strict guideline of being straight up or down. Another one is stepson. Can your IRA lend your stepson $10,000? Deal or no deal? That one is deal, not blood related. Now, if the IRS sees you're trying to skirt the rules by loaning to one of these not necessarily disqualified persons and then have them kind of lend the money right back to you, the IRS considers that what's called the indirect rule, that you're trying to skirt the rules, and they can consider it prohibited if you're trying to just kind of work your way around it. So there is no real way to be creative here. These rules, just kind of try to think of them as black and white. Now what about here, your daughter-in-law, $10,000, deal or no deal? This one's no deal. Your kids and their spouses are disqualified. So before you get into an investment, you have a question, feel free to ask me. That's what I'm here for. If I don't have the answers, I can at least direct you to where to look in the tax laws. So let's go to the next piece here. All right, I get the basics here. How do I put money in a self-directed IRA? Well, self-directed is really a marketing term, meaning we allow you to direct your investments to everything allowable under IRS guidelines. So funding an IRA with us, we have traditional IRAs, Roth IRAs, SEP IRAs. It's just like funding any other IRA with any other financial institution. So if you have an IRA with a brokerage house or insurance company, you can open up a corresponding one with us. We'll do what's called a trustee-to-trustee transfer. Move the cash funds over to the IRA with us, which allows you to invest in the alternative asset space. If you have funds in an old employer plan, like a 401k or 403b, you'll want to open up the IRA, then request with your old administrator a direct rollover, and they'll make a check payable to the new IRA. You don't want to have it come to you as a distribution and then to the IRA, because the IRS will take out a little piece there. Question I get here all the time, Brian, what about my current employer plan? Can I move those funds over? The answer to that is maybe. If your employer plan allows what's called an in-service rollover, you could potentially move your current retirement dollars into an IRA. But it depends what type of employer plan you have and whether that plan does allow it. So if anybody has any questions on that, please let me know. So 2014, you can also make annual contributions. And you have until generally April 15th to do so. And with some of the employer plans, you even have until October 15th to make some of your plans. But most people fall into the category of having a traditional Roth IRA, where they can contribute up to $5,500 a year. If you're over the age of 50, the IRS has said you can make a little extra contribution of another $1,000 to those plans. The other plans that we see a lot here is a SEP plan, which is a self-employed pension. It works very much like a traditional IRA, but it's for the self-employed individual and their employees. In this case, the self-employed individual can contribute up to 25% of their adjusted gross income to the plan with a cap at $52,000. So it's a lot more of a contribution than a traditional IRA, as you can see from here. Another plan that we'll talk about here is what it listed here is an individual K. You'll hear it called a solo K, solo 401k, individual 401k. It's really the same plan. And what it is, it's a 401k plan for the self-employed individual that has no W-2 employees. And it's a part of, Section 401 for people that are familiar with 401k plans that says if you don't have any W-2 employees, you can be the trustee and administrator of your own 401k plan. And I'll go into detail how that works a little bit. We call our plan the 1K. So you create your own 401k plan, and we help you do so. This plan, you are the plan administrator of the plan, and you're the plan trustee of the plan. So different from an IRA where you have to have a custodian, with a 401k plan, you can quote-unquote be your own custodian or trustee, as the verbiage permits here. You're also the plan participant. So just like a company 401k plan, you're the participant. So you can make contributions as the employee and then do company matches as employer. And you can contribute up to $52,000 a year to this plan. And that doesn't include being able to roll over from other plans itself. So you can make contributions as employee up to $17,000 a year, or if you're over 50, $23,500 a year. Then as a company match, you can match generally up to 25% of your adjusted gross income. The combination between the two is $52,000. If you're over 50, they allow an extra $5,500 catch-up contribution of $57,500. Now, if you're married and your spouse is in the business with you, they do not count as an additional employee. So the two of you combined could potentially put in over $115,000 into one of these plans a year. And then you can direct the investment directly from the 401k plan, or you can create an LLC or some type of trust to direct the investment from there. So it doesn't matter if you're sole proprietor or if you're incorporated. You can roll over any old pre-tax retirement dollars, so any old 401k plans, any old traditional or SEP IRA plans, and then you could start making your contributions to start your direct investments. Some benefits of the 401k over the IRA. It comes with checkbook control right away because you're the plan trustee. You can loan yourself money as a plan participant. So that's a little bit different than an IRA where you can't loan yourself money. And so it's not an investment, but as a plan participant, you can loan yourself up to $50,000 a year. There's some caveats there if anybody has any questions. And then you're free to do all the investing. So again, the checkbook control is a great thing. Being able to loan yourself money is a great thing. And if you're buying real estate and you're using leverage, there's also a tax that it avoids that IRAs don't avoid. And if anybody has questions on that tax, I can go into that. Now, there's also checkbook control with an IRA. This works a little bit differently. This goes back to a case from the 90s called the Swanson case, in which this guy Swanson started an international business that his IRA was the owner of and he was the manager of. The IRS said, oh, we think that's a prohibited transaction, and the IRS ended up losing the case. So bore the checkbook IRA. And a lot of times you'll see this in a couple different setups. One of it's through an LLC. In the LLC model, the IRA becomes the sole member of the LLC. This makes it a pass-through entity, a disregarded entity, so there's no federal tax that would have to be returned unless the IRA engages in a tax prohibited issue. And then it would have to pay the franchise tax board of that state a tax. In California, that tax is $800 a year plus a gross receipts tax. So that's why a business trust, especially for those in California that want a checkbook IRA, is a good method. So it's taxed just like a partnership. So it's also a pass-through entity. In this case, the IRA is the sole beneficiary owner, and you make yourself an unpaid trustee. The beauty of the trust, you don't have to worry about paying the California Franchise Tax Board those $800 a year plus gross receipts tax fees. So if anybody has more questions on this, check out my website on retirementcheckbook.com with more information about the checkbook IRA. With an IRA, we make it very simple. You can open up your account online within a matter of minutes, and then we work on funding the account. That can take anywhere from a few days to a few weeks, depending on where your retirement dollars are and how liquid they are. So if you have some investments coming up, you'll want to talk to me about, hey, this is where my retirement dollars are. How quick do you think you can get them all over? I'd say on average it's 2 to 3 weeks. And then we take about 2 days to fund an investment. Again, you're not limited to the stock market. You have real estate, notes, and all different types of investments that you can do with your IRA. So from there, here's my contact information. You can look at my website at AccuPlanSanDiego.com. Email me at briandavis@AccuPlan.net. And with that, I'll turn it over to Kevin. Kevin, are you there?
I am here, Brian. Can you hear me?
I can hear you just fine.
Terrific. Well, I'd like to thank you for the opportunity to be here with you today. I learn something every time we do one of these things. Very excited about the opportunity to share some time with you, and you do a fantastic presentation. And I just implore anybody that they have any questions about what Brian was just talking about, please indeed get in contact with him so that you can get those fine questions, the fine-tuning questions answered. Brian is a great guy. AccuPlan is an awesome company, and you certainly couldn't do wrong doing business with Brian.
Well, thank you for the high praise. And again, while Kevin's getting started here, if anybody has any questions, sorry, jumped up on your toe there to say just make sure to write them in the chat box or ask questions. And Kevin, I'll leave it to you.
Okay. Thank you, sir. You're very kind. And for whatever reason, I'm having a little bit of a technology issue here today. I can't see the questions and my screen at the same time. There's a little hiccup in the system somewhere, so all I can see is my presentation screen right now. But I want to welcome everybody for being here with us today. Brian did a great job of introducing a self-directed IRA. I'm going to show you a vehicle that people can use a self-directed IRA for, and I'm very grateful to Brian for giving me the opportunity to share that with you. It's only going to take me about 15, 20 minutes as well. I want to just plant the seed with you guys to see if any of this resonates with you. Then please follow up with some questions as well. I'll give you my contact information at the very end. But what I want to talk about with you for a few minutes is the road to financial freedom using California's premier real estate vehicle for the 21st century. That's what we do here at CalChoice. And at the end of the day, what's been very interesting lately is Brian talked about the fact that there's all this money, trillions of dollars locked up inside of qualified plans, and only about 2 to 4% of that is actually doing something other than traditional stocks, bonds, mutual funds, paper assets. But interestingly enough, this is from the Bloomberg News just back in February. Morgan Stanley, you know, one of the biggest brokerage houses in the country, is now talking U.S. millionaires as the top alternative asset class to own this year. Even Morgan Stanley is talking about alternative asset classes. It's a huge departure from the traditional stock brokerage approach, which is stocks, bonds, mutual funds, paper assets, paper assets, paper assets. Even they are seeing that transition, and they're kind of seeing that they're going to have to get on board with it if they want to stay current with what's going on in the market. And you can see here that real estate deals, because as interest rates go, it's going to put downward pressure on the flat and single-family dwellings. And right now, there's not a lot of that downward pressure because the Feds have their foot on the brake, you know, with the quantitative easing, you know, keeping the percentage rate at like 0.25 in terms of interest rates. So once the Fed actually starts backing off and we get to see what the economy really is doing, inflation is going to go up, interest rates are going to go up, and now is definitely the time to get in, because owning real estate is attractive because of the expected appreciation of property value. And I'm going to share some very specific examples of that with you here in just a minute, how we do it here at CalChoice. But the simple question we always ask everybody is, do you have a roadmap to your financial freedom? I've been in this business a very long time. We talk to financial advisors and their clients all day, every day. And what we know is that more people spend more time planning their 2-week vacation than they do their entire financial future. They think that somehow they're going to get to retirement and it's going to be magic and they're going to have enough money to be able to live till they pass away. And the simple truth, here's a stunning number for you. The average 401k plan in America has $47.8 thousand in it, 48,000 bucks. That's it. Think about that. How long is that going to last you if you retire? No time at all, right? And then our life expectancy is getting longer and longer and longer. The average life expectancy now is 78 years old, and people are going well beyond that. So what's going to happen is where people are going to have, they're just going to run out of money. So it's one thing to have those paper assets, stocks, bonds, mutual funds. Hopefully they're getting you some returns that you want. Hopefully you're not getting damaged in those things. I'm going to have a little different conversation about that in a moment. But you need something in the background that's also building. So when you do retire, you can have the opportunity to have had this growth in the background that's going to supply that extra cash for you once you do retire. Most people right now, I don't believe, are actually going to be able to retire because they don't have the growth going on. They have maybe some security going on, but they don't have the great growth they need. And that's what we do here, is help people with that growth factor. And just a little bit of history about us. Our company was founded by Andre Vicario. He is the CEO and president of CalChoice Investments. He is a financial investor himself, been so for nearly 20 years, and he has broken off himself and started CalChoice Investments because he saw the need to have these alternative investments for folks, and something that does give people that growth we were just talking about. And we've helped thousands of families, individuals, and businesses, and at the end of the day, we all here have a collective over 30 years in the land banking industry between all of us, so we're pretty confident what we do, and I'm going to share a few more details about that here in just a minute. For example, who are we? Our only purpose in life is to fill the long-term financial goals of our clients with our proven land banking solution, always keeping our customers' long-term growth at the forefront of every decision we make. And at the end of the day, here it really is in a nutshell, folks. Our mission is to ensure American families are educated on the power of land banking and the financial wealth and security it can bring them, because this has been a strategy reserved for the very wealthy since the beginning of time, pretty much. If you think about it, all of the wars, if you look back hundreds and hundreds, thousands and thousands of years, they weren't fighting over silver and gold. They were fighting over land. Whoever owned the land had the power. And even today, we can look at the Ukraine, for example. I mean, they're not fighting over goods and services in the Ukraine. They're fighting over, or Russia's looking at adding that land to Russia because it's where the power comes from. Now, keep in mind, once again, this has been a strategy reserved for the very wealthy for a very long time. And what we've done here at CalChoice is made this bite-sized and palatable, understandable, and available to virtually everybody. You don't have to be a millionaire to be a land banker anymore. You can do it literally today, and I'm going to show you how we do that for you. Why land banking? It's get caught up or get ahead. If you lost some money in the downturn of the market, it hasn't come back yet. Literally everybody that works with us makes money with the stroke of a pen because of the equity we provide up front. It also allows you to put yourself in an equity position, as I said, because everybody gets equity instantly. And then do what the millionaires do. At the end of the day, your bank is doing it. Pension funds are doing it. Hedge funds are doing it. Movie stars are doing it. People that have money are land banking. And now we've made it available to everybody. So here's a couple examples for you. Bob Hope, great funny guy. When he passed away, he was worth hundreds of millions of dollars. The first $100 million or so came from the fact he was a great entertainer. The rest of the money came from the fact that his brother was a financial advisor, and as Bob made the money, his brother was investing in some little-known places back then called the San Fernando Valley and Palm Springs. And those have since obviously blossomed and bloomed, and that's what made the estate of Bob Hope worth hundreds of millions of dollars. Howard Hughes, he owned Las Vegas before it became Las Vegas. It was called Loveland, and he slowly but surely sold it off, became a multimillionaire, and even to this day, the Hughes Corporation owns a lot of land around the LA International Airport, continues to make that corporation tons of money. And of course, Donald Trump, whether you like him or not, it's a whole different story, but you have to admit he's got a knack for making money, and in his case, it's come from developing the land, but he always starts with the land. That's where it's been for him. Oprah Winfrey recently bought 36,000 acres of land, and when somebody asked her why she would do that, she simply said because the land is always going to be there. There's not one person that can make a financial mistake with my money and have it all disappear. The land is always going to be there. I can count on it. And then here's media mogul Ted Turner, literally the second largest landowner in America. He owns 1.2 million acres of land just by himself, and he's a guy that knows how to make money. A couple other examples you might not have heard of. How about McDonald's? You know, they own all of the land under all of their restaurants all across the world, except those you might find in Walmart. So you can imagine how many McDonald's that is and how much real estate that really turns into. Or, for example, the Catholic Church. And I'm not talking about whether we agree or disagree with their philosophy, but they own all of the land under all of the Catholic churches all across the world. Can you really imagine how much land that turns into? And when they had their legal trouble just a few years ago and had to pay off some enormous fines, they just sold a couple of churches, paid off the fines, didn't wrinkle them even a little because they got all the other churches across the world and all that other real estate. And even the Mormon Church, and once again, I'm not talking about whether we agree or disagree with the philosophy. We're talking about business sense here. The Mormon Church, just at the end of last year, purchased 466,000 acres of land. Their total land holdings now in the Mormon Church are almost 700,000 acres. And once again, business-wise, they love to be debt-free and they love to be financially secure. So we can look at people and companies and see what they're doing, and even churches, and know that land is the core foundational element of a lot of the financial security for these people. Most of the people on this webinar today have probably heard of CalPERS, the big pension fund here in California, a huge land banker. They own massive amounts of land because they know it's a great foundation for the entire pension fund. Now, here's a little secret from a guy called Warren Buffett. You guys all know Warren. He does not make mistakes in terms of business. His business philosophy has always been find an asset that's undervalued, that's working, that's undervalued, hold it, and then sell it for a profit in the future. That's Warren's pretty much financial summary in terms of any investment he looks at. But he also says be fearful when others are greedy and be greedy when others are fearful. And what he's talking about here is the fact that even in our own economy, it's a little bit squirrely. We don't really know what's going to happen. You know, in the European economy, it is not settled. We're not sure what's going to happen there. In the Asian markets, there is some uncertainty of what's happening in the Asian markets. So when there's this fear kind of permeating the entire economic structure, it's time to get greedy and take care of yourself. And I'm going to show you some of the things he's doing personally here in just a few minutes. But this is our proven land banking method here in a nutshell. It is so simple, and it actually goes right along with that Warren Buffett philosophy. A, acquire select pre-developed land in the growth path of a major metropolitan center. Buy it undervalued, buy an asset that's working already, but buy it undervalued. Look there, wait for its value to mature, and then sell it for a profit in the future. This is Warren Buffett's business philosophy in a nutshell, and I didn't even know that we had the same synergy in terms of our business model until just recently when I was reading a bit about Warren Buffett and realized that that is how he buys businesses. It's what we've been doing since we got started in the land banking business. So we know what we do works, but the key is the land has to be in the path of growth. That's where it all begins, down at the bottom in gold there. And I'm going to show you some specific examples here in just a minute. Keep in mind, there has to be something going on in the area where we focus all of our energy already. So it's not like we're just taking and starting out from zero, hoping some growth is going to start somewhere. There has to be something going on. So this is a photo in the area we work in just several years ago. This is overlaid with a current photo. You can see there's new schools, new shopping centers, new houses going in. So there already has to be some growth in the area. We just put people in the path of that growth, and it helps them make money. And this is a great place where I can kind of jump off and let you know that we are a real estate investment company. So we purchase and sell land. That's all we do. And so all of the parcels that we sell, we've purchased first. So it's not just a matter of us taking your money and going to try to do something with it. We have a very specific formula that we use to make sure the land that we purchase is going to be in a position to appreciate. We purchase it first, make sure there's no tax, no title issues, then we turn around and sell it with equity to others. It's a great plan, and it's working great. And as I said, it's land, folks, so I'm going to do that again. It's not pretty, it's not sexy, it's not glamorous, this is not great cocktail party conversation. What it is safe, secure, and it makes people money. So as you can see here, as the streets come in, the buildings, the houses, the high-rise, this is the residential, the commercial, the industrial, what it does is it eats up the supply of land. It's a supply and demand issue. As the demand for the land increases and the supply shrinks, it drives up the value. And it's the same, frankly, whether it's land or widgets or how about at Christmas time, that last Game Boy at Walmart, you know, where people, old ladies will stomp on kids to grab that last Game Boy for their grandchild. You know, it's a supply and demand issue. It's a universal principle that works in every facet of life. It works exactly in the land business too, because as you can see in this photo, there is a city out in the background there. It's growing this way. This city is growing towards it. It's shrinking that supply of land in the middle and driving up the value. Because keep in mind, the land does not have to be developed in order for it to go up in value. Actually, we don't want to develop it because it costs so much money to develop it. You would lose money, right, at the end of the day. And actually, where I'm speaking to you from right now in Chino Hills, about 10 years ago, the land that I'm speaking to you was going for about $20,000 an acre. Now, I can look out my window in my office here and see there's a hotel, there's a shopping plaza, but right in between them, there's a little strip of land. It's several acres. That land right now is $999,000 an acre. So just 10, 12 years later, it went from $20,000 to $1 million an acre. That's what we're talking about, and that's why doing developed land can be cost prohibitive. It's just too expensive. So there's a very let me say that again. There is a very specific formula that we use, and we have to have a way that we do it so we know it's going to work. And there's three kinds of land. There's undeveloped, developed, pre-developed. We focus all of our energy in that pre-developed area. As you can see, the developed land on the right, that's what I was just talking about, is very expensive, and it's subject to market cycles. As you can see up there at the top, it goes up and down with the market. On the left, there's undeveloped. For those of you that know anything about California, let's say between Barstow and Las Vegas, plenty of land, you can get it cheap, but it's never going to be worth anything because it's in the middle of Death Valley, so not necessarily good. So where we live is in that section right in the middle. It's called pre-developed land, and that's where all the profit is created. Once again, very simple, buy low, sell high using the supply and demand principle. We focus all of our energy right here in California because it has the largest population in the entire United States. And then we take it even further and compress the area we focus on into 60-mile radius around Los Angeles. And you can see even a third of that's out in the water. So it's that supply and demand issue maximized to the supreme. And you can see here that over half of all of the people in California live in 2/3 of that 60-mile radius around Los Angeles. We're expecting another couple of million over the next 10 years. And quite frankly, there's only one place left for them to go. I'm going to show that to you momentarily. But the statistic I never get tired of sharing with folks is that there's more people living in the Los Angeles basin than in Oregon, Nevada, Arizona, Idaho, Utah, Montana, Wyoming, and New Mexico combined. And I was literally just on the freeway coming to the office a while ago with 200,000 of my closest friends. And when I leave the office this afternoon, it'll probably be more like 250,000 of my closest friends trying to get home in bumper-to-bumper traffic. And it's the price we pay for living here in Southern California with that congestion. And you can see it right here in this chart. I'm speaking to you from, right here in behind the growth path, the word growth path. This is that San Fernando Valley Bob Hope's brother was investing in. Palm Springs is way down to the right, but this is Southern California proper. This is where the 18.5 million people live. Oh, that went horribly wrong. That's where the 18.5 million people live, and you can see it is thoroughly gridded up. There's no place left for people to go except for up the 14 freeway into that 3,000 square mile in the red triangle called the Antelope Valley. Right now there's only about 500,000 people living out there. There's 3,000 square miles, only about 500,000 people, and we know that's where they're going to go because it's the last open area in Southern California where people can go. And even the state knows that's what's happening because they recently just did the interchange here at the 2.5 and the 210. They spent about $300 million widening that from a 4-lane highway to now a 14-lane highway at its largest point, because even the state knows the traffic flux is going to be heading in that area, and for a change they got out ahead of congestion and made it easier ahead of time as opposed to waiting until it's already over congested and then shutting down lanes to work on it and just making the process even worse. So even the state of California recognized where the people are going. And as I said earlier, we have a very specific formula that all of the land has to meet in order for us to purchase it first, because we have skin in the game on every parcel. It's not like we're just saying, hey, give us your money. We're going to go see if we can get lucky and do something with it. We have a very specific formula that all of these have to be in place before we'll purchase a piece of property. And as I highlight these up, you can see that each one of them has to be in place, with the key at the bottom being the Regional Master Plan for Community and Municipal Infrastructure. That's really the key. There already has to be something going on in the area, as we saw in the photos earlier. And then here in this particular scenario with the pictures, you can see a little company there called Walmart down on the bottom in the middle. And one thing, and I ask people this all the time, I was just doing a couple presentations in Burbank last night, has anybody ever seen a Walmart fail? The answer is no. They have a terrific research and development department that knows exactly where to put stores, and they like to have about 250,000 people per store to support the low prices they have. And ultimately, as I said, in the Antelope Valley, there's only 500,000 people out there, but Walmart has 6 stores. So a great company with great research and development like Walmart is not going to put 6 stores in an area that they think are going to fail. They're putting them there knowing full well that people are coming and they're getting out ahead of the growth in the area. Same as the state knew where the traffic is going to go. They got out ahead of that, and they widened the freeway ahead of time. And there's more and more clues just like that coming. For example, I'm going to tell you a few more here in just a minute. We've been land banking in this area for 10 years. But once again, let's go back to Warren Buffett. He put $2.5 billion of his own money into land banking in the Antelope Valley to build solar farms. When somebody, I mean, think about it. Warren Buffett could put money anywhere in the world, but he chose the Antelope Valley. And when he was asked why he did that, he simply said, because there's no place poised for the explosive growth in the next decade as the Antelope Valley. So he is very hot in the Antelope Valley. He owns 10% of a Chinese company who came and put a factory in the Antelope Valley. We think of all of our business going to China. Well, in this case, China came here, and they're building electric buses in the Antelope Valley and shipping them all over the country. Warren Buffett has about a 10% stake in that company. I'm positive that's why it ended up in the Antelope Valley, because he is very hot on the Antelope Valley right now. And they literally already have orders for the next 10 years for electric buses. It's got to be very popular. A few other things going on in the area. As you can see here, Morton Manufacturing is celebrating its grand opening in the Antelope Valley. They're literally moving from LA proper out to the Antelope Valley. And there's a reason why companies are doing that, because they know that now, it used to be people would live in the Antelope Valley and then drive to LA. Well, now the industrial, retail, and commercial sectors have caught up so quickly that people can now live and work in the Antelope Valley. And companies like to know they have a workforce that has affordable housing. And right now you can still get a 3,000 square foot, 2-story house in the Antelope Valley for a couple $100,000, actually $210,000. And they're actually building what are called net zero houses out there, meaning they are completely independent from the electric grid. They have their own solar power, so they draw nothing from the grid and actually sell power back to the grid. And by 2020, they want to have what are called double net zero houses in the Antelope Valley, meaning they also have little water plants at the house that recycles as much water as possible for landscaping, that sort of thing. So the houses will draw very little from the actual water resources in the Antelope Valley, because they'll have their own little water plants in the houses as well. So it's called double net zero, and they're literally building them right now. The single net zero houses, they can't keep them fast enough. They're selling them as fast as they can build them. The double nets are coming. Lancaster was recognized as the most business-friendly city for the second time since 2007, and this is why companies are leaving not only the Los Angeles area, but coming from all over the country and the world to Lancaster because of the tax breaks they get for bringing business there. And Lancaster's made it very easy for people to do business. They've won this award now twice since 2007. They also just won the International Award for their downtown redevelopment. So think about this. Out of all of the cities all across the world, Lancaster just last year won for being the best redeveloped downtown area. It's a pretty stunning award for a town that used to be a little sleepy town. It's now known all over the world and just won an international award. So lots of great things happening in the area. Dick's Sporting Goods, you've all heard of it, national sporting goods chain. They just came in and took over the old Gottschalk's building in the mall. Gottschalk's did not make it. And a great company like Dick's Sporting Goods, they're not going to come in and do that if they don't think there's going to be people there to help support the store. Same with Macy's. Macy's came in and anchored the Antelope Valley Mall. They're now the anchor store in the mall. They would not do that if they didn't think it was going to be a successful venture for them. And then right here on the right, this is the Transit Village. This is literally, you can walk right out to the train station from here and take a train into LA if you want. And the high-speed rail, once it's done, will literally stop in Palmdale right by this place. So literally you can get from downtown LA to Palmdale in 15 minutes. And they're actually filling these up. And you can rent a 3-bedroom, 2-bath condo in this village for $1,000 a month. That's the kind of affordable housing that's going on out there. Here's a little bit on the high-speed rail. You can see we've already authorized the bonds. It's going to create hundreds of thousands of jobs. At the end of the day, it's tied up in court again. It's not getting off to an easy start. People either love it or hate it, but I believe it's coming. It's just going to be a matter of time. And in addition to the 10 years experience, actually we have over 30 years experience here in the office, but we've been, as a company, focused on this area for the last 10 years. We also have statistics to back up everything we say, and that is we had a study done that looked at over 9,000 properties sold over the previous 17-year period ending in 2012. We're trying to get it updated right now with the last couple of years because it's even better in the last couple of years than it was previously. But what we found over the previous 17 years, and keep in mind this included the downturn in the market and the late 2005 or 2007 through 2010, so it even covered that horrible dip in the market. And what we found is the actual results of the average annual property appreciation rate in the Antelope Valley was 24%. Now, I'm not quoting you 24% here today because that's an average, so some are lower, some are higher. It's a pretty incredible number if you think about it. And we know that the average hold period was 3.7 years, although we talked to everybody about keeping in mind that this is called land banking, so we want it to be a long-term patient money strategy of 7 to 10 years. That's the window we like to have people looking at. Even though we know it's shorter, we'd much rather under-promise and over-deliver, letting everybody think that it's a 7 to 10-year window, knowing fully that it's probably going to be way less than that. And about 85% of our business does come from people with qualified money, like Brian was talking about just a bit ago. So what we do is most qualified funds can only be invested, as Brian was saying, in stocks, bonds, mutual funds, that sort of thing. So we show people with Brian how to open a self-directed IRA and then take a portion of that money, roll it into the self-directed IRA, and then purchase the property. And then the self-directed IRA holds that grant deed for you inside of your IRA. Because keep in mind, it's a diversification strategy, so we want you to make sure that you have plenty of liquidity with soft assets, the paper assets, insurance policies, annuities, that sort of thing. But you have to have some hard assets working for you, building that growth in the long run, because I personally believe there's going to be some bloodshed in the stock market here in the reasonably near future. I'm not going to go into the great details on why I believe that now, but trust me, it's coming, and when you see it coming, you'll have heard it here first. So you have to have something to offset that, and that's the perfect thing that land is for, because you can get these great kinds of appreciation rates, and you get instant equity when you purchase a parcel as well, anywhere between 30 to 50%. So literally you're buying parcels at 50 to 70 cents on the dollar. It's a great way to make money instantly, and then these great appreciation rates kick in on top of that. Which one of your assets qualify? You can see here all of these different assets can be used in terms of rolling over into a self-directed IRA. 1031 exchange, if you own some real estate, want to sell it, not a problem. You can park your money via a 1031 exchange in some land to avoid the capital gains. Then, of course, cash is king. We love cash because those transactions can close very quickly. Otherwise, it's 2 or 3 weeks, as Brian said, to get the money rolled over into your self-directed IRA. And the good news is, between Brian and myself, we help you with all of that. You're never going to be left on your own. It's a very straightforward process. We both do it all day, every day. and we can make sure it's smooth and seamless for you. We have a $40,000 minimum to be involved in land banking, although if anybody on this call here today, I'm going to offer a special deal to you here in just a few minutes, but our minimum is $40,000. And what that does is most of our parcels, trust me, are way more expensive than $40,000. Our lowest priced parcel right now is $150,000, but you can still leverage that smaller amount without a loan through what we call tenants in common. So with $40,000, you can get into that $150,000 parcel through a tenants in common scenario, or you could even get yourself into a $500,000 parcel that you could not have gotten into otherwise through our very special tenants in common agreement. And it's like I say, it's a way to leverage without a loan to control an undivided interest in an entire parcel. So it's not like you'd have the top corner or the bottom corner. You get an undivided interest in the entire parcel for your specific percentage, and you receive a grant deed, fee simple, title insured piece of property. So it's not like we're doing a REIT, which is basically a mutual fund for real estate, or it's not a co-op. You actually get a grant deed in your name, or in it would be held by Accuplan for the benefit of you if you're using a self-directed IRA. Very simple, and I could go over more questions if you have them privately outside of this. We believe it's the right place, the right time, and you're with the right company. Because of the great research we do, the customer support, we buy and offer only select parcels that present specific advantages and benefits. We price below current market value. This is from a couple that are from Arizona. Andre met these folks, and her father, as you can see here, used to work for the Bureau of Land Management. Their dad said, you can't go wrong buying land because they just aren't making it anymore. And they're from Arizona. There's plenty of land in Arizona they could have bought, but they know the process we use to make sure the properties are going to be in a position to appreciate. That's why they purchased with us. So essentially, ask yourselves, does it seem like it could be right for you? If the answer is yes, how do you get started? Simply, I'm going to give you my contact information here in just a minute. I challenge you to give me a call, and I will take you through a little bit more information to make sure this is right. I'll ask some questions that are pertinent to finding you the right parcel. Then I'll match up a parcel directly with you. I'll show you that parcel, make sure it makes sense to you, and then we'll decide and move forward. It's very straightforward. Once we do decide, I'll fill out a reserve my property form for you, and the time, of course, is to act. Now, if you were referred here by someone because we sent this out to a lot of people, and there's actually a lot of people on this webinar today, then get back to with whoever referred you to this webinar and have them contact me. I'd be very happy to talk to them. However, if there is any problem at all, you can get a hold of me directly at Kevin P. That's Kevin P. as in Peter at calchoiceinvestments.com. Once again, Kevin P. at calchoiceinvestments.com. My phone number is area code 909-256-0365. Once again, 909-256-0365. And I'm going to make a special offer today. Like I said, I mentioned our minimum is $40,000. We actually have right now in our possession, it's a small percentage of a parcel that's left over. I believe it's about 7+% in a fantastic parcel that's only $28,000. Every once in a while this happens, even though our minimum is 40. Once in a while a parcel doesn't fill out exactly in $40,000 increments. So if somebody out there today is thinking this might be for them, but they're like, hey, I don't have 40, but I've got 28, please get a hold of me right away. I will go ahead and put you in that parcel. I'll show it to you first, make sure it's exactly what you want, and then we'll get going. So today I have a special offer at $28,000. So if you or anybody else you know might be able to take advantage of that, I challenge you to do so. And with that, I'd like to thank Brian again for the opportunity to be here and share this concept with you guys. Always very proud and happy to be able to share a screen and some mic time with Brian. He's an awesome guy. Accuplan is a great company, and I challenge you all to contact him as well for getting a self-directed IRA open or a SEP or a solo 401k, whatever works best for you. Make sure you get together with Brian and get that going. And with that, I thank you all for being here. I can't, unfortunately see the questions screen because I'm having a little snafu here with my technology. But Brian, are you still with us?
Well, yeah, I am. Thank you so much, Kevin. A lot of great information there. And, yeah, we do have some questions here. I think you kind of answered it. The most recent question was, what's the typical price of the parcel?
We have parcels. That's a great question. I'm glad somebody asked it. Right now, the minimum sized parcel we have, it's a 5-acre parcel for $150,000. But our parcels vary in size. We try not to go much below 5 acres, but they go anywhere from 5 to 25, 30 acres. And we have price points anywhere from this 150,000 all the way up to 7 figures. It doesn't matter. We have a huge inventory. It's constantly in a state of flux. That's why I have to look at it per call with whoever's calling to match them up the best with the property. But literally, we can match anybody up with any parcel at any time. So what we do is we look at the dollar amount, how much time they have to retirement, what their goals and plans are for the future, and then I'll match them up with a parcel I believe is going to work best for them at the time. But other than the minimum being $40,000, we can make a smaller. We can certainly make that work too, and make that. And I'll have that conversation with you.
Sounds good. Here's another question. This is more located at me. What are the gains in land that are taxed in the self-directed IRA? And all the earnings go right back into the IRA. So depending on if it's a traditional or Roth IRA, it would be tax-deferred or tax-free. So there is no capital gains taxes on any of the earnings when you're buying these properties in your IRA.
Which is what makes this such a great tool. I'm sorry, I didn't mean to cut you off there.
Oh no, that was it.
Because if you use the self-directed IRA for land, the grant deed is going to be held on your behalf inside of the self-directed IRA. So when it sells, the grant deed floods out, the cash floods in its place, and it sits in there, as Brian said, either tax-deferred or tax-free, depending on whether you have a Roth or a simple IRA. And then even if you have the simple IRA, you're only going to be taxed as you take distributions. So it's not a big...
Another question for you here, Kevin. That says, are you selling your own inventory, and how do you price it?
That's a great question. Thank you. A very sharp question. I'm glad somebody asked it. And the simple truth is yes. CalChoice Investments is real estate investment land. So yes, we buy all of the parcels first. We make sure there's no tax issues, no title issues. They're all clean and ready to go. They're also in the one of the things I love about CalChoice, I didn't go into that much here in this particular webinar. We don't really even just buy in the path of growth. We buy more infill properties. So these are really in the middle of growth. And if you join me on another webinar some other time, I'm going to show you some specific examples of parcels. They're more infill than actually in the path of growth. And here's how we do it. And it's a great question. And believe it or not, I get it all the time because we offer equity, and people are like, well, why would you do that? Well, the simple truth is this. We pretty much buy sub-wholesale. So we have the ability through a great acquisition department to find and purchase terrific parcels at a great price that allow us, obviously we have to mark them up some to cover our business expenses, but what I love about being here at CalChoice is since we have a huge volume of business, we're not Walmart by any means, but we do enough business where we can pass that equity savings on to the end user because we want you to be so happy that you worked with us that you're going to tell all your friends and family and have them come work with us as well, and it'd be good for everybody. So at the end of the day, the president and CEO of the company, Andre Vaccaro, his appetite for profit is low. We have several thousand financial advisors across the country that bring us their clients to help diversify their portfolio. So it allows us to do a good volume. And keep in mind, it could be that it might take us 2 years to actually get a parcel in our inventory because of the negotiations we have to bring up a title or takes, but we have a great inventory that runs in it's a D7-figure number. It's always in a state of flux because we're buying and selling every day, but we do have the ability to pass on a 30 to 50% equity position to everybody that does business with us because we want you to be so happy, like I say, that you worked with us, that you'll tell your friends and family. And once again, it's a way to make up money right out of the gate. If you've lost money, and if you haven't lost money, then you're that much further ahead. So we love to give people that equity position, so it makes your money work exponentially hard in terms of getting equity up front and then that great appreciation rate on the back. I hope that answered the question.
Yeah, I think we have a couple other questions here for you. Do you provide comparable listings when you sell property to an investor?
That is a great question. I love this crowd today. They're asking super sharp questions, and the simple answer is yes. Just like if you were going to list your house for sale, you're going to call a real estate agent. He's going to come over with a property profile. He's going to show you all the comparables in your area. Your guy's going to come up with a price that works for selling your house. We do virtually the same thing with land. At the end of the day, this is a real estate transaction. However, we're just the principal in the transaction because, as somebody asked earlier, we're selling our own land. So at the end of the day, all of our properties come with a 17-page profile that has, marketing notes of what's going on in the Antelope Valley, marketing notes with specific to the property. It has maps, charts, graphs, and more importantly, comparables, so that you can see what our price is, virtually what's happening against all the active listings in the area, all the pending listings in the area, and all the sold listings. And we do that within a mile and as close to in the last year as possible. Land is a little bit different than houses, but we are experts at putting those comparables together so that you can see our price versus what's actually happening in the area and see how exactly the equity position you're getting. So yes, that's a great question. I'm so glad someone asked it.
All right, and I think this is the last question I see listed here, so if anybody has any last questions, try to get it in right now. How do you compensate advisors?
Oh, people want to make money?
Yeah, somebody just said I might want to help on this.
Oh, I know. That was the comedy portion of our presentation this morning. I'm sorry. Basically, we have a very specific process that we use to make sure that advisors that we can work with. So I would be happy to entertain that question. We do have what are called finder's fees for advisors. We don't pay commissions, I'll be honest with you, because we actually close all the sales here. The job of the advisor in the field is to do what we call introduce and qualify. So you qualify them, make sure they have money. Then you set them up with me. I do a webinar. I show the property. I close the sales. Brian and I help transfer the money. Well, sometimes it's chasing, I'll be honest with you. But we help with all the money moving. But that's a very specific question I'd be more than happy to talk to somebody individually about to make sure that this is a good match for their advisory business. We believe it actually, as I said, we have several thousand advisors across the country that bring their clients to us to help diversify their portfolios. So that is our business model, but I'll give you specifics on how it works on a personal basis, not necessarily here on the webinar. But is it possible? Absolutely.
All right. Well, that's the last question I see here. I want to thank everybody for taking the time out of the day. If anybody wants a recording on this, please email me, Brian Davis at Accuplan.net. We were recording this today. And again, thank you everybody for time out of the day. Kevin, thanks again. Look forward to doing this in the future with you again.
All right, and thank you, Brian. It's always awesome. And once again, everybody, please make sure you give Brian some business because he is a great guy. Accuplan is a great company, and we love to work with him. So thanks, everybody. Have a great day.
All right. Thank you.
Bye-bye.